The internet changed the world. That did not stop the Nasdaq from falling almost 78%, and it did not stop peak Cisco buyers from waiting 25 years just to see the stock recover its old high. That is the uncomfortable lesson for anyone investing in AI in 2026. You can be right about the revolution and still be wrong about the investment. The dot-com era's most expensive mistake was not believing in fake technology. It was paying tomorrow's price for a future that took another decade to arrive. One side says AI will transform the economy, so the spending must be justified. The other sees hundreds of billions going into data centers and says this is 2000 all over again. Both sides are skipping the part that decides who actually makes money. Today, we will follow the money from Netscape to dark fiber, from pets.com to Amazon, and then bring that history into 2026. By the end, I will give you 4 signals that tell us when an expensive boom is becoming dangerous. My name is Phoebe, and you're watching TradingKey. And our story begins on the 9th of August, 1995, when Wall Street priced 10 years into one day. Netscape sold a web browser at a time when connecting to the internet sounded like a fax machine arguing with a smoke alarm. During the first half of 1995, Netscape generated just $16.6 million in revenue and no profit. Its IPO was expected to price at $14. Demand became so intense that it was repriced at $28. The stock opened at $71 and closed at $58.25. By the end of that day, Netscape was worth about $2.9 billion. That IPO became the starting gun for the internet bubble. Yet, buyers correctly understood that the browser could become the front door to communication and commerce. Their mistake was about timing and ownership. Browsers had weak barriers to entry. Microsoft could bundle Internet Explorer with Windows, while browsers had no proven way to capture their value. Search advertising and mature e-commerce were still years away. Netscape investors saw the destination, then they valued the company as if the highway had already been built. That is the first AI mirror. A startup can attach a model to a familiar product and receive a multi-billion-dollar valuation before anyone knows whether users will stay. The technology may be extraordinary. The business model can still be unfinished. Growth replaced profits. After Netscape, Wall Street began rewriting the rules of valuation. Internet companies argued that old metrics no longer applied. Distribution was nearly free, so whoever spent fastest could dominate and figure out profits later. Page views became more exciting than cash flow. The logic sounded reasonable: capture attention now, monetize it later. Yahoo's audience exploded and Amazon's revenue climbed. Every winner helped finance 10 weaker imitators. By the peak, many internet companies were losing money. Cisco traded near 100 times forward earnings, close to $100 for every dollar of expected annual profit. The Nasdaq 100's trailing P/E remained above 100 even after the index had fallen roughly 50%. That last point is worth sitting with. Valuations were so extreme that cutting prices in half did not make the market cheap. The modern version is weak retention, API calls without positive gross margin, and token growth that costs more to serve than customers will pay. Usage is important, but usage is not a business model. For an AI product, ask whether revenue per customer can exceed inference, acquisition, and engineering costs. Growth without retention may be rented demand rather than a durable franchise. America overbuilt the internet. While websites were buying Super Bowl ads, an even larger boom was unfolding underground. The Telecommunications Act of 1996 increased competition. Cisco, Lucent, Nortel, and the carriers raced to install fiber and long-distance networks. Then came Y2K. Companies feared old systems would fail in 2000, pulling years of hardware upgrades into a short window. Wall Street treated a one-time surge like a permanent growth rate. Forecasts claimed internet traffic would double every few months, implying there could never be too much capacity. It became a classic capital cycle. High returns attracted capacity, and that capacity destroyed the returns. Adding fiber to an open trench was cheap, so rational company decisions created irrational industry oversupply. America built the interstate before the exits into homes were ready. The backbone existed, but the last mile remained slow and expensive. Demand could not reach the infrastructure fast enough. Fiber remained dark and bandwidth prices collapsed. The capacity eventually became useful, but later buyers acquired much of it from bankrupt owners at a fraction of its cost. That is the second mirror for AI. The 4 largest U.S. hyperscalers are expected to spend roughly $725 billion in 2026. Goldman estimates their combined spending could reach $5.3 trillion from 2025 through 2030. Those numbers do not prove a bubble. Data centers are full and cloud demand is growing. But they create the same timing question. Are we building capacity in line with profitable end demand? Or are we building the interstate before enough paying traffic can reach the entrance ramp? 5 matches, 1 fire. The bubble collapsed when perfect expectations encountered ordinary reality. Beginning in 1999, the Federal Reserve tightened policy and pushed rates to 6.5%. Money became expensive for companies dependent on financing. Then the market began examining cash. On the 20th of March 2000, Barron's published Burning Up, warning that at least 51 internet companies could exhaust their cash within a year. That day, MicroStrategy revealed a financial restatement after materially overstating revenue. Its stock fell 62%. 2 weeks later, a federal judge ruled that Microsoft had violated antitrust law. Regulation had placed a price on the dream of natural monopoly. On April 14, the Nasdaq fell about 9%, completing a weekly decline of roughly 25%. Margin calls and fear began feeding one another. Finally, weakness moved upstream. Customers cut orders, Lucent and Nortel issued warnings, and Cisco recorded $2.77 billion in inventory-related charges and commitments. The industry's most valuable products had become warehouse problems. The Nasdaq Composite lost almost 78%. Cisco fell about 89% and did not exceed its dot-com record until December 2025. 25 years to get back to even, before inflation. That is why the company will survive is not enough. A wonderful company can remain a poor investment for an entire career if the starting valuation assumes too much. The business model decides. Nothing captures the difference between a good idea and a good business better than Pets.com. Americans loved their pets, and Amazon acquired a stake of roughly 50%. In its first fiscal year, Pets.com generated only $619,000 in revenue, while spending $11.8 million on advertising. The real problem was even worse than the marketing bill. Dog food and cat litter are heavy, with thin retail margins. Subsidized shipping meant faster growth could accelerate losses. Every new order looked like traction. Economically, many of those orders were liabilities. Pets.com went public in February 2000. By November, it was liquidating. The public market story lasted less than 9 months. Amazon also came close to the edge. Its stock fell about 95% from its dot-com high, while the company lost money and carried debt. Amazon had a broader product mix, repeat customers, and improving fulfillment economics. Crucially, it raised roughly $672 million just before capital markets closed. That financing bought Amazon time to cut costs and survive until online payments, broadband, and logistics matured. This is the distinction AI investors need today. The modern Pets.com creates more compute expense than durable customer value, with investors financing the gap. The modern Amazon has liquidity, repeat customers, improving economics, and an advantage competitors cannot rent overnight. 3 similarities that matter. Now we can compare 2000 with 2026 without forcing the analogy. Infrastructure is again racing ahead of monetization. Cloud companies generate real AI revenue, but spending is growing faster. Wall Street estimates put the 5-year buildout between $4 and $8 trillion, with Goldman's model near the upper end. Will the revenue earn an adequate return on that capital? Funding is also shifting toward debt. JP Morgan Asset Management says hyperscalers issued about $121 billion of bonds in 2025, with issuance expected to rise sharply in 2026. Their balance sheets remain stronger than in 2000, but debt markets are becoming part of the growth engine. Then there is financial entanglement. Under a conditional agreement, NVIDIA could invest up to $100 billion in OpenAI as a planned NVIDIA deployment comes online. OpenAI has also contracted to purchase another $250 billion of Azure services. Amazon is investing billions more in Anthropic, while Anthropic commits to future AWS capacity. The compute is real, but the customer, supplier, cloud provider, and investor are increasingly tied together, which makes end demand harder to read. Imagine I invest in a restaurant, which then uses my money to buy ovens from me. The sale is real, but it tells us little about paying diners. In the same way, infrastructure demand can remain strong before an AI lab has generated enough cash from independent customers. If a major lab delays capacity or loses funding, weakness can travel through cloud bookings, GPU orders, networking, and power equipment. That is not proof of fraud, it is concentration risk. Why 2026 is not 2000? After all those similarities, you might expect me to call the top. I am not. The biggest difference is that today's public market leaders make extraordinary amounts of money. Nasdaq data shows that 99 of its 100 companies reported positive net income in 2025, and 95 generated positive free cash flow. At the dot-com peak, many had no earnings, while the index's trailing valuation likely reached 150 to 200 times earnings. Today, the index trades around $22 to $25 for every dollar of expected profit. It is not a perfect comparison, and some AI stocks are far more expensive, but the gap from 2000 is enormous. Profitability is also strong. The S&P 500 reported a 13.1% net margin in the third quarter of 2025, the highest in FactSet's history going back to 2009. Credit markets are not signaling distress. In July 2026, the extra yield demanded on high-yield bonds was around 2.7 percentage points, close to historically tight levels. Borrowers are not paying crisis rates. The platforms also have businesses outside AI: Microsoft's software, Alphabet and Meta's advertising, and Amazon's commerce and cloud operations. If one model disappoints, these companies do not disappear the next morning. That strength can extend the cycle. It can also make overbuilding larger because cash-rich companies can keep investing long after a startup would be forced to stop. So this is not 2000, should not be confused with there is no risk. The more accurate conclusion is that any bubble is uneven, modest in profitable megacaps, extreme in some private valuations, and dangerous where projects require perpetual financing. How an AI bubble could break. If this cycle eventually breaks, I see three plausible paths. The most likely is a return on investment shock. The Magnificent Seven account for roughly 1/3 of the S&P 500. If a hyperscaler cuts spending or reports poor AI monetization, index concentration and passive ownership can amplify the move. Another path is regulation. The European Union's AI Act becomes broadly applicable on the 2nd of August 2026. Copyright, transparency, and safety rules need not ban AI to hurt valuations. They only need to slow deployment or raise costs. Then there is technological obsolescence. A breakthrough in inference efficiency, model compression, custom silicon, or on-device AI could sharply reduce the centralized compute required for a task. That would not mean AI demand disappeared. It could mean yesterday's expensive equipment earns a much lower return. Fiber faced this problem. Data demand grew, but transmission improvements multiplied network capacity. Investors forecast the traffic and still overestimated the infrastructure's value. For semiconductor investors, ask whether task volume grows faster than compute per task falls, and whether those tasks run on the same hardware at the same margins. Is the top already here? So is the AI bubble about to burst? The evidence says not yet, but not yet is not the same as never. Start with capital spending. During the dot-com cycle, real business investment peaked before the 2001 recession. In 2026, hyperscaler spending is still accelerating, not rolling over. The dangerous change would be a broad sequence of capex cuts rather than one company shifting a project by a quarter. Next comes profit. Before the dot-com crash, corporate profit growth weakened, while technology stocks kept rising. Today, public company margins remain strong. I would become more defensive if AI-related revenue slowed, while depreciation, power, and financing costs continued climbing. Then, watch credit. Follow high-yield spreads, data center financing terms, and bond issuance. A rapid widening would tell us that lenders no longer trust the cash flows supporting the build-out. Finally, look at unit economics. Do not be hypnotized by tokens, users, or model rankings. Watch paid retention, gross margin after inference cost, revenue per unit of compute, and the capital required to produce each new dollar of sales. That last metric separates adoption from value creation. The technology can win while investors lose. The dot-com bubble teaches us that markets struggle with timing. In 1995, investors saw a connected world. They did not know Microsoft would crush Netscape, search would monetize the browser, or bankrupt telecom assets would make the next generation cheaper to build. The future arrived. The profits did not go to everyone who funded its first version. AI sits in a similar gap between technical possibility and economic capture. Demand is substantial, public leaders are profitable, and credit remains open. That makes 2026 different from the weakest dot-com companies. But capex is enormous. Financing relationships are intertwined, and many applications have weak retention and unproven economics. Stop treating every layer of the AI stack as the same investment. For me, the key question is not, is AI a bubble? It is, where has the stock price moved further into the future than the cash flow? Follow the cash, not just the capacity. The strongest companies will own a durable bottleneck, generate cash outside the funding loop, and improve as usage scales. Subsidized growth will disappear when capital becomes expensive. Pets.com had the right market and the wrong economics. Amazon had time, liquidity, repeat customers, and infrastructure that became more valuable as it scaled. Cisco built the internet and still left peak buyers waiting 25 years. That is the whole lesson in 3 companies. The revolution can be inevitable. Your return is not. Do you think today's AI market looks more like Amazon building through the crash or Cisco selling infrastructure at an impossible valuation? And which part of the AI stack feels most like Pets.com to you? Tell me in the comments. I'm Phoebe with TradingKey. Subscribe for the next episode, where we will open the financial statements of the AI giants and test whether their cash flows can actually support the spending. I'll see you there.